Imagine having the power to profit whether stocks soar or crash, with just a fraction of the cash you'd need to own them outright. Options trading, calls and puts, unlocks that potential, but it's a double-edged sword. Ready to learn how it works and if it's for you? What are options and why trade them? Options are contracts giving you the right, but not the obligation, to buy or sell a stock at a set price by a specific date. They're like a bet on a stock's future move, up or down, without owning it. Calls bet on price increases, puts bet on drop. Take Jamal, a 29-year-old tech worker with $2,000 to invest. Instead of buying 10 shares of a $200 stock, he buys a call option for $200, controlling 100 shares. If the stock jumps to $220, his option could double in value, a 100% return versus 10% for shares. Per CBOE data, options trading volume surged 35% in 2023, driven by retail investors like Jamal. Options amplify returns through leverage but amplify losses too. A 2022 Fidelity study showed 60% of retail options traders lost money due to inexperience. Jamal likes the thrill but knows it's not gambling, it requires strategy. Emotionally, options feel like a high-stakes chess game, exciting yet daunting. Jamal starts with a paper trading account on Thinkorswim, practicing without risk. Practically, he opens a brokerage like Robinhood, needing only $100 to start. It's accessible but demands learning the rope. Key terms: the strike price is the set price, expiration is the deadline. Jamal focuses on learning these, building confidence before risking cash. Understanding call options. A call option gives you the right to buy a stock at a strike price before expiration. If you think a stock's going up, calls let you profit big with little upfront cost. For example, Sophia, a 34-year-old nurse, buys a $50 strike call on a $48 stock for $2, or $200 per contract, as each covers 100 shares. If the stock hits $60 by expiration, her call's worth $10, $60 to $50, a 400% gain. If it stays below $50, she loses the $200. Per 2023 CBOE data, call options dominate 55% of retail trades due to bullish optimism. Why calls? They cap losses at the premium paid but offer unlimited upside. Sophia's drawn to tech stocks like Tesla, where volatility fuels big moves. She checks X for sentiment, seeing hype around a new product launch, boosting her confidence. Risks: time decay, options lose value as expiration nears. Sophia picks options with 30 to 60 days left, balancing cost and time. She uses free calculators on optionsprofitcalculator.com to project outcomes, feeling empowered by clear math. Practically, start with in-the-money calls, strike below stock price, for higher success odds. Sophia practices with $100 trades, learning to read price charts before scaling up. Understanding put options. Puts give you the right to sell a stock at a strike price, profiting when prices fall. They're like insurance, protection against drops or a bet on decline. Consider Noah, a 31-year-old freelancer. He buys a $100 strike put on a $105 stock for $3, $300 per contract. If the stock falls to $90, his put's worth $10, $100 to $90, a 233% gain. If it rises, he loses the $300. A 2022 Schwab study showed puts gained popularity in bear markets, like 2022's 20% S&P 500 drop. Puts shine for hedging. Noah owns 100 shares of a stock at $105. His put ensures he can sell at $100, capping losses. Alternatively, he bets on a retailer's decline after poor earnings, using X posts to gauge market mood. Time decay hurts puts too. Value erodes if the stock doesn't move. Noah picks 45-day expirations, avoiding rapid decay near expiry. He uses Yahoo Finance to track stock fundamentals, ensuring his bets grounded. Practically, Noah starts with out-of-the-money puts, strike below stock price. For affordability, testing with $200 trades. It's a calculated way to profit from downturns. Benefits of options trading. Options offer flexibility, profit in any market, up or down. Leverage means small investments control large positions. A $500 call can mimic owning $5,000 in stock, amplifying gains. Elena, a 27-year-old teacher, uses options to diversify. In 2023, she buys calls on a tech ETF during a dip, earning 50% when it rebounds. Her risk? Just the $300 premium. CBOE data shows options traders average 20% higher returns than stock-only investors in volatile markets. Hedging is another win. Elena's puts protect her stock portfolio, like insurance. She feels in control, not at the market's mercy. Options also allow strategies like covered calls, selling calls against owned stocks for extra income, yielding 2 to 4% monthly per 2023 JP Morgan data. Emotionally, it's thrilling yet strategic. Elena uses TradingView to analyze trends, picking high-volatility stocks for bigger moves. She starts small, ensuring losses don't derail her. Practically, learn one strategy like buying calls before branching out. Elena's focus on basics builds a foundation for bigger plays. Risks of options trading. Options can burn cash fast. Unlike stocks, options expire, worthless if your bet's wrong. A 2023 FINRA report showed 70% of retail options trades expired worthless, especially for beginners. Liam, a 33-year-old engineer, buys a $200 call that expires out of the money, losing his full premium. Emotional hit, frustration like betting on the wrong team. He learns time decay accelerates near expiration, wiping out value. Volatility cuts both ways, big wins, big losses. In 2022, aggressive traders lost 50% plus on speculative options during market swings. Leverage amplifies this. $1,000 can control $10,000, but a 10% drop wipes out the investment. Mitigate by risking only 1 to 2% of capital per trade. Liam uses stop-loss orders on options, limiting losses at 20%. He checks X for trader warnings, avoiding overhyped stocks. Practically, stick to liquid options, high trading volume, for better pricing. Liam practices with paper trades, refining strategy before real money. Choosing the right options strategy. Options strategies vary by goal. Buying calls or puts is simplest, bet on direction. More advanced. Selling covered calls for income or spreads to limit risk. Mia, a 30-year-old freelancer, starts with buying calls on a biotech stock after positive drug trial news. She risks $150, aiming for 50% gains. A 2023 Schwab study showed simple strategies suited beginners, with 60% success on liquid stock. For income, Mia tries covered calls, owning 100 shares and selling a call for $200 monthly. If the stock stays flat, she keeps the premium. Risk, missing big gains if the stock soars. She aligns strategies with risk tolerance. Low risk for steady income, speculative for growth. Mia uses options play to simulate outcomes, feeling confident in her choices. X posts guide her to trending sectors like AI for timely bet. Practically, master one strategy before experimenting. Mia's focus on calls builds skills without overwhelming her. Setting up an options trading account. Getting started is straightforward but requires preparation. Open a brokerage account with options approval. Think Fidelity or Interactive Brokers. Most require a risk questionnaire, as options are high risk. David, a 35-year-old consultant, applies for Level 1 approval, basic strategies, with $1,000. He links his bank, enabling margin for advanced trades later. A 2023 CBOE survey showed 80% of retail traders started with under $5,000. Learn the platform, most offer tutorials. David uses Thinkorswim's free tools, like option chains showing strike prices and premiums. Emotionally, it's exciting but nerve-wracking. He practices with $100 trades to ease in. Security matters. Enable two-factor authentication. David sets a $500 monthly budget, risking only what he can lose. He follows X for platform reviews, ensuring reliability. Practically, start with paper trading to test strategies. David's cautious approach builds confidence before real trade. Monitoring and managing options trades. Options move fast. Monitor weekly, not obsessively. Check price movements, time decay, and news impacting your stocks. Use apps like TradingView for alerts. Sophia, now 35, tracks her $300 call on a retailer. When earnings beat expectations, her option jumps 40%. She sells, locking in $120 profit. A 2022 Fidelity study showed active monitoring boosted returns by 15% versus set and forget. Adjust if conditions shift, say, a stock stalls near expiration. Sophia rolls her option to a later date, preserving potential. She checks X for market sentiment, avoiding panic during volatility spike. Risk management. Set exit points. Sophia sells if losses hit 25% or gains reach 50%. This discipline prevents emotional trades. Practically, use stop-loss orders and track volatility via CBOE's VIX index. Sophia's routine, weekly checks, clear rules, keeps her trades sharp. Options trading, calls and puts, offers big rewards but bigger risk. We've covered how they work, their benefits like leverage and flexibility, and risks like time decay and losses. Start small. Paper trade, pick one strategy and build from there. Options aren't for everyone, but with knowledge and discipline, they can supercharge your portfolio. Take one step today. Open a practice account and test the waters. Check the description or pinned comment for free options trading tools and exclusive tips to get you started. Since you're still here, YouTube's lined up the perfect next video for you. It's on screen now, so keep learning.